So that brings me now to the last topic, which is corporate bonds. Corporate bonds are borrowing from corporations. So it's risky. It's not US government debt. And I want to give you an example of what's happening right now in the biopharma industry. We're actually making use of debt in some pretty creative ways. And a good example of this is what happened just a few days ago. A company by the name of Axovant, a publicly traded company that was started up 2 years ago, that's focusing on neurodegenerative diseases, including a drug for Alzheimer's, they announced just a few days ago that they borrowed $55 million from a hedge fund venture debt investor to be able to prepare for drug development on a number of their programs, including a particular Alzheimer's drug that's going to get some kind of FDA announcement later on this year in a phase 3 trial. This is a company that was started up just a few years ago and launched by taking a compound out of GlaxoSmithKline and raising some money to develop it. It's an Alzheimer's drug. And I showed you last time that the last time we had an Alzheimer's drug was, anybody remember the year? 2003, yeah. It's been close to 14 years since we've approved an Alzheimer's drug. They're going after this really huge opportunity, and they're raising debt. They already raised equity. When they did their IPO, at the time, it was the largest IPO in the history of the biotech industry. They raised $315 million in a day. And now they've gone back to not equity markets, but bond markets, debt markets, to be able to raise an additional $55 million of capital. So clearly, the issue about borrowing has to do with risk. We need to know what risk we're taking. And so in the bond markets that people transact this $39 trillion of debt, the role that's played by rating agencies cannot be underestimated. Rating agencies are there to assess the risk of default in these various bonds. And they'll give you a grade based upon that risk. Each of the rating agencies, Moody's, S&P, and Fitch, those are the three largest, they have different ways of grading bonds. But just to take one, for example, Moody's will give you AAA, AA, single A, BAA, although recently they've changed the BAA denomination to BBB just because it's kind of confusing since other organizations use BBB. These are the different categories of risk that they have assessed for bonds of these various different types. And so before you are able to sell bonds to institutional investors like pension funds or mutual funds, you need to get them rated. There are bonds that trade without rating, but they're much smaller, more illiquid. And so the Axovant debt, that's not a rated bond. That was borrowing between two parties. It's a private transaction. But because Axovant is a public company, they have to announce it and provide details of the transaction. But in the case of these kinds of rated debt transactions, once a debt is rated, effectively the rating agency is blessing it and say, we've looked at the financials, we've looked at the business model, it looks kind of good, not so good, really good. They'll tell you by the ratings. And that will allow these bonds to be sold to large numbers of investors. So just to give you a little bit of a sense of the differences in yield, these are bond indexes from Bank of America Merrill Lynch over the course of the last 20 or 30 years that show you the yields across the different ratings categories. So BBB right now is yielding something on the order of a little less than 4%. If you want to borrow BBB, that's the lowest rating category that's still investment grade. That's still above a certain threshold for institutional investors to be able to invest in. A little bit more than 3%. That's kind of extraordinary. Capital is out there and ready to be deployed. That's the opportunity, even for bonds that have a certain degree of risk. Now, when we look at the risk premium, when we look at the premium, it's not just risk premium. I want to be very careful in how I use my terms. So a number of academics have tried to decompose the difference between treasury bills and these corporate bonds. That spread, they've tried to decompose it into various different categories. Credit risk, default risk, liquidity risk, market risk. There's lots of different kinds of risk. And the way to think about it systematically is to take a look at a bond and ask the question, what is it promising? What is it expected to deliver? And what are the differences between those two things? So when a bond promises to pay back $1,000 and it's currently trading at a price of $321.97, you can actually calculate what it's going to yield in the case it delivers on its promise. And in that case of $1,000 over a period of time, 10 years, where the current bond is trading at $321.97, the promised yield is 12%. Now, that's not what we expect the bond to pay. The bond has a certain default probability based on its rating. And so if it's going to pay you $1,000 in the very best case, and it's got a 70% probability of defaulting, in fact, you're more likely to get $300 of that $1,000, right? That's the expected payment. So based upon what you expect, you can actually calculate the expected yield. And the expected yield for this bond is about 19%. So over a 10-year period, we're expecting this bond will default maybe 24% of the time. So out of $1,000, you're getting about $760. You're getting an expected yield of about 9%. The difference between the promised yield and the expected yield, that difference is known as the default premium. After all, that's what you're getting as extra value because the bond is risky. The difference then between the expected yield and the risk-free yield, like treasuries, that's the risk premium that is associated with market risk, liquidity risk, all of the other risks that are not related to default. Okay? So it's actually very important for you to understand this, because when you're looking at a bond, you need to understand what the sources of risk are and whether you're comfortable with those risks, whether you can manage those risks, whether they're appropriate for your investment purposes. So this just is a graphical depiction of those differences. So I want to just leave you with a little bit of a sense of what these default rates look like for the various different bonds. So this is data from Moody's from 1920 to 2015. It's a long, long time period, almost 100 years. And what is plotted here is the actual default experience for bonds of various different ratings after 1 year of issue, after 2 years, 3 years, 4 years, 5 years, and so on. So if you wait long enough, even a AAA bond, the very best, safest, highest rated bond, if you wait long enough, AAA bonds will default after 20 years at a rate of about 1.4%. That's how good a AAA is. Even after 20 years, of all the bonds that have ever been issued AAA, after 20 years, only 1.4% of them have defaulted. Do you now understand why these ratings are important? It gives investors transparency. It gives them comfort that we've looked at this, and based upon history, you don't have to worry. Very safe. On the other hand, if you take a look at, I don't know, speculative grade, these are like junk bonds. After 20 years, more than a third of them have gone under. So those are really risky. In fact, those don't look like bonds. They're more like equity, because when the bond defaults, you basically get the collateral, which is the equity of the company, whatever's left. The equity holders, they get wiped out. Here, you get whatever they had. Good luck with that. So junk bonds end up being not considered bonds. They're more like hybrid instruments and equities. Also, these default rates, they change over time. So you've got to be very careful in that business cycle booms are going to look very different than business cycle troughs for default rates. The risks are going to be complex. And we'll talk about that more explicitly. Also, when you take a look at the amount of recovery that you get after a default, the recovery rates also vary greatly depending on whether you're in business cycle booms or busts. After the financial crisis, the recovery rates, the loss rates on these kinds of structured finance deals ultimately ended up being very, very difficult to manage for investors.